Morning. Good to see you. And of course, staying with us is Arjuna Mahendran from HSBC Private Bank, our guest host. What are your expectations for the data that we're watching to come out of China soon, the FAI, urban FAI, and also industrial production?
I think that industrial output will show a year-on-year growth of 7%, which is more than consensus calls for, ended in December, because we have been seeing signs in the PMI sentiment measure of an increase even in month-on-month production, which I think is a fantastic result for the Chinese economy at a time where exports are declining. On the other hand, our call for fixed asset investments is that growth will slow to only 21% because the government-mandated investments will take more time to feed through to data, and at the same time, private sector is slowing.
Private sector is slowing, and that accounts for about 70% of the economy in today's China. Does that mean that net-net we are going to definitely see more policy response in terms of lower rates even, higher triple Rs?
In terms of monetary policy, we definitely are going to see more cuts of lending rates, deposit rates, and the triple R, because the steep fall of inflation to below zero means that in real terms, policy has become more restrictive. Fiscal policy, I believe, is also behind the curve because there has been no adjustment since November, and in the meantime, the global economy has really turned much more down than what we were expecting late last year. I'm very surprised no new measures are being announced this week, and I expect them in the course of the first half. Otherwise, growth will slow substantially below the 8% target.
Dariusz, hi, that's a very interesting point. This is Arjuna. I just wanted to find out your view on inflation now that we've officially gone into deflation territory, and as you correctly point out, the fiscal stance hasn't significantly altered to take account of that. Do you think this deflation could get much worse, or do you think it'll just remain relatively mild for the rest of the year?
Actually, our forecast is that it will remain at levels close to the minus 1.6% reached in February, basically because commodity prices globally have probably bottomed out, and at the same time, increase in final domestic demand will prevent consumer prices from falling too sharply. Yet still, the average inflation this year will be minus 1%, which makes the government target of plus 4% look totally unrealistic.
Okay, and what does this mean for basically consumption and spending in China? Because, I mean, if indeed we are in a if deflation has started in China, it reminds me of Japan, 20 years ago, when, look, why buy now when I can buy it cheaper tomorrow, next week, next month?
I don't think that this is what's going to happen in China. My belief is that the lower prices will actually stimulate demand. And when you look at real retail sales, their growth rate has been consistently increasing. And our call is that in nominal terms, retail sales will grow only 17.5% in the first 2 months of this year. But in real terms, this would mean a growth rate of above 19%, which would be record high. So I think that the decline in prices actually will be stimulative for Chinese consumption and overall economic growth.
I mean, Dariusz, I think I agree with you in the sense that Chinese consumers are starting from a much lower base than their Japanese counterparts, and therefore they have much more appetite to consume. But having said that, can the government and the central bank actually fine-tune this deflationary pressure to such an extent that they can actually keep it within 1%? Do you think that's actually feasible?
I think that it is going to depend on two factors. First, what's going to happen with global commodity prices, because right now they are really depressing producer prices, purchasing prices, so there is some downside risk for CPI there as well. But on the other hand, if the government manages to stimulate domestic demand, especially consumption, which it seems to be pretty good at doing so far, the demand increase will prevent prices from falling too much.
Okay, Dariusz, listen, we'll get back to you in just a bit also to Arjuna Mahendran, our guest host. Okay,